Good day, everyone. It's a pleasure to welcome you all back to our ongoing lecture series on accounting and finance for managers. Today, we'll delve into a topic that lies at the very heart of accounting operations, a practical and essential framework that governs how business transactions are systematically recorded, reported, and analyzed. The accounting cycle. Mastering this topic is vital because it equips managers like yourselves with the tools to interpret financial data accurately, identify potential errors or fraud, and make well-informed decisions that drive business success. Let's break down today's session into 4 key areas. An overview of the accounting cycle, the core principles that guide transaction recording, the mechanics of journal entries, and the critical role of internal controls and audit trails. By the end of this lecture, you'll gain a deeper appreciation of how these concepts work together to ensure the integrity and reliability of financial information. 1. Overview of the accounting cycle. To begin, let's establish a clear understanding of what the accounting cycle is and why it's indispensable to any organization. The accounting cycle refers to a structured, step-by-step process designed to capture, organize, and summarize all financial transactions within a specific accounting period. This systematic approach ensures that no transaction, whether big or small, is overlooked, and that the financial records of the business remain complete, accurate, and up-to-date. Here's a breakdown of the key steps in the cycle. 1. Identify and analyze transactions. Spot business activities that have financial implications and evaluate their impact. 2. Journalize the transactions. Record each transaction in the journal, also known as the Book of Original Entry. 3. Post to the general ledger. Transfer journal entries to the ledger where accounts are maintained. 4. Prepare a trial balance. Summarize all ledger balances to ensure debits equal credits. 5. Make adjusting entries. Update accounts to reflect accrued or deferred items and other adjustments. 6. Prepare an adjusted trial balance. Confirm the accuracy of accounts post-adjustments. 7. Prepare financial statements. Generate reports like the income statement, balance sheet, and cash flow statement to summarize performance. 8. Make closing entries. Close temporary accounts, e.g., revenues and expenses, and reset them for the next cycle. 9. Prepare a post-closing trial balance. Verify that only permanent accounts remain open and balanced. This sequence provides a structured roadmap for tracking, processing, and summarizing financial activities. Without it, businesses would struggle to maintain consistency and accuracy in their financial reporting. For managers, understanding the timing and purpose of each step is crucial for interpreting financial statements and ensuring they reflect the true financial health of the organization. 2. Core accounting principles: accrual, matching, and revenue recognition. Now that we've outlined the accounting cycle, let's focus on the guiding principles that dictate how transactions are recorded. These principles provide the foundation for accurate and ethical accounting practices. Accrual principle. The accrual principle mandates that revenues and expenses are recognized in the period they are earned or incurred, regardless of when cash changes hands. This approach ensures that financial reports reflect the economic reality of the business rather than just its cash flow. For example, imagine your company delivers consulting services in December but doesn't receive payment until January. Under the accrual principle, the revenue from this service would be recorded in December, aligning it with the period in which the service was provided. This practice gives stakeholders a clearer picture of the company's financial performance during each specific period. Matching principle. Closely tied to the accrual principle is the matching principle, which requires that expenses be recorded in the same period as the revenues they help generate. This ensures that profitability is measured accurately. Consider this scenario. You launch a marketing campaign in October that drives sales in November. The cost of the campaign should be recorded as an expense in November alongside the revenue it generated. This alignment prevents misleading financial results and helps managers assess the true return on investment for business activities. Revenue recognition principle. The revenue recognition principle specifies the conditions under which revenue should be recorded. Revenue is recognized when control of goods or services is transferred to the customer, not necessarily when payment is received. For instance, a construction company working on a multi-year project might recognize revenue progressively based on the percentage of the project completed. This approach ensures that financial statements reflect the actual progress and value delivered, providing a fair representation of ongoing operations. By adhering to these principles, organizations can produce transparent, consistent, and trustworthy financial statements. As a manager, understanding these rules allows you to interpret financial reports with confidence and spot any deviations that might indicate errors or manipulation. 3. Journal entries: original, adjusting, and closing. Next, let's turn to the mechanics of recording transactions: journal entries. These entries serve as the building blocks of the accounting system, capturing the details of every financial event. Original journal entries. These are the initial entries made to document business transactions as they occur. They include day-to-day activities such as sales, purchases, payments, and receipts. For example, if your company makes a credit sale of RM 10,000, the journal entry would look like this. Debit. Accounts receivable RM 10,000 credit. Sales revenue RM 10,000. This entry reflects the increase in receivables and asset and the corresponding revenue earned. Adjusting entries. At the end of the accounting period, adjusting entries are made to account for items that may not have been recorded during the period. These include accrued revenues, accrued expenses, prepaid expenses, depreciation, and unearned revenue. For instance, if employees have earned RM 5,000 in salaries by the end of the month but haven't been paid yet, the adjusting entry would be debit. Salary expense RM 5,000. Credit. Accrued salaries payable. RE 5,000. This ensures that expenses are recognized in the correct period even if payment hasn't been made. Closing entries. Once the financial period ends, temporary accounts like revenues, expenses, and dividends are closed to retained earnings. This resets these accounts to zero, preparing them for the next cycle. For example, debit. Revenue RM 50,000. Credit. Income summary 50,000. Debit. Income summary RM 40,000. Credit. Expenses of 40,000. Debit. Income summary RM 10,000. Credit. Retained earnings 10,000. As a manager, reviewing journal entries provides valuable insights into the flow of transactions and enables you to detect discrepancies or irregularities that might indicate inefficiencies or fraud. 4. Internal controls and audit trail. Finally, let's discuss two critical safeguards that ensure the reliability of financial data: internal controls and the audit trail. Internal controls. Internal controls are policies and procedures designed to protect assets, minimize errors, and prevent fraud. Examples include segregation of duties, dividing responsibilities so no single person handles all aspects of a transaction. Authorization requirements, ensuring that expenditures and payments are approved by authorized personnel. Physical safeguards, using locks, safes, and password-protected systems to secure assets and data. As a manager, your role is to enforce these controls, especially in high-risk areas like payroll, procurement, and inventory management. Strong internal controls not only protect the company's resources but also foster trust among stakeholders. Audit trail. An audit trail is a chronological record of all transactions and changes made to financial data. It provides transparency by documenting who performed an entry, when it was made, what changes were approved or modified. If discrepancies arise or fraud is suspected, the audit trail serves as a powerful tool for reconstructing events and holding individuals accountable. Managers should prioritize systems with robust audit trail capabilities and conduct regular reviews to ensure compliance and accuracy. Conclusion. In summary, today's lecture has highlighted the fundamental processes and principles that underpin the recording and analysis of financial transactions. The accounting cycle provides a structured framework for capturing and summarizing financial activities. Core principles like accrual, matching, and revenue recognition ensure that financial data reflects economic reality. Journal entries form the backbone of accounting, while adjusting and closing entries ensure accuracy at period end. Internal controls and an audit trail safeguard the integrity of financial information and promote accountability. By mastering these concepts, you'll be better equipped to analyze financial data, ask insightful questions, and enhance the financial practices within your team or department. In our next session, we'll shift gears to explore management accounting, focusing on cost behavior, budgeting, and decision-making using accounting data. Thank you for your attention, and as always, stay financially aware.